your take. Are you planning to retire in the next years? If so, do you believe that your current income will support your lifestyle? If the answer is yes, then great for you. However, if you want more, I suggest you watch until we begin. And if you enjoy this kind of content, please hit the like button, subscribe, and enable notifications to stay up to date on everything that happens. With Tesla's stock prices expected to soar to an astounding $1,000 per share by 2026, leaving its current value of about $200 far behind the forecast for the next 5 years. This represents a remarkable opportunity in autonomous driving that could potentially reach trillions of dollars, according to a groundbreaking report on the company. How much would you be ready to risk if you were to buy in Tesla shares right now? Even a tiny portion of this enormous market would have a big impact on Tesla and position them as the front runner. With more groundbreaking innovations to come, Tesla has emerged as a leader in the electric vehicle market. With these lofty objectives, the firm not only wants to produce outstanding products, but also makes an effort to keep costs as low as possible. By sales, it looks like Tesla will overtake all other automakers in the globe in 2026 or 2027. Taking into account Tesla's present valuations and prospects, investors might be wise to upgrade their overall investment rating to a more optimistic bond grip. Let's examine why. Greetings to all and welcome back to Tesla Tomorrow. In the rapidly growing electric vehicle industry, Tesla has maintained a strong market share even in the face of the entry of multiple competitors. Unlike some of its competitors that struggle with profitability, Tesla has maintained its position over the years, and it is probable that their dominance will only grow as the sector expands further. Tesla has established itself as a very successful company, making its shares a desirable long-term investment. Tesla has completely revolutionized what it means to be an automaker. In addition to making electric cars more widely known, Tesla has transformed sales tactics by going direct to consumer instead of through traditional dealerships. The company has also abandoned traditional advertising in favor of gaining media attention and utilizing word of mouth. Marketing. With its premium brand image, Tesla has soared to new heights thanks to these audacious bets that have paid off handsomely. Industry experts predict that Tesla will consistently generate substantial consumer demand while cutting costs that legacy automakers take for granted. The average price target for Tesla stock over the next 12 months is expected to be around $218.95 per share, but some estimates are as high as $430.33. While others sink to a measly $33,333, let's focus on the financial aspect of things. In North America, the average monthly expense per person, when other extraneous costs are taken into consideration, comes to almost $3,000. Travel and medical attention, given that this amount rounds up to about $5,000 per month or $60,000 annually, you would need roughly $2 million to live comfortably for the next 33 years. What does this mean for your retirement and any potential test to share, especially in light of Tesla's current valuation? It appears likely that this stock will be a wise investment in the upcoming years for a number of reasons. Investors should watch out for two possible catalysts that might have a significant impact on Tesla in the near future. Tesla is projected to continue on its upward trend. First, impressive delivery numbers show a strong indication of higher than expected vehicle demand. Secondly, Tesla's profitability at the gross margin level is above expectations. These positive developments are encouraging for the company's long and medium-term financial outlook. The possibility for a sharp increase in the rate of adoption of electric vehicles is one of the main reasons bolstering Tesla's optimistic outlook, even though current market estimates for the US by 2030 range from the mid-40s to the mid-50s percentage points. According to a study analysis by Needham and firms, manufacturers might have far greater targets in mind. The survey states that most automakers want to see 100 of their sales go towards electric vehicles by 2030 or 2035. This suggests that analysts may have been unduly conservative in their estimations, allowing for favorable shocks that would eventually favor Tesla and the market. Future growth for Tesla won't only depend on rising auto sales. The firm has seen notable revenue growth from its services and other businesses over the years, and there's still plenty of space for growth in other areas as well. Supercharging for Tesla revenue has a lot of promise. According to a Goldman Sachs research paper, the additional revenue opportunity maybe somewhere between $1 and $3 billion in the next few years if Tesla allows all EV drivers to use its supercharger network. Future profits per share SS. Growth for Tesla is anticipated to be rapid, possibly even surpassing its revenue growth. The possibility of a capital return to shareholders and operational leverage are the main drivers of this optimistic forecast. The potential for Tesla to gain from favorable operational in 2022. Leverage is clearly seen in the third quarter, even though operating expenditures increased by only 2.3 compared to the company's noteworthy 55.9 growth in revenue. Tesla demonstrated its capacity to turn a profit, which highlights how the company's finances gain from successful operations. Leverage and share repurchases can further enhance the company's potential for future profits per share growth. During Tesla's Q3 2022 earnings call, the company highlighted the ability to repurchase up to $10 billion in shares. Okay. Even in the event of a negative outcome, as a result of selling 491 zero cars in the US, Tesla has been creating ripples in the market. Tesla overtook BMW, which had held the top spot for the previous 3 years, to become the US leader in luxury sales. However, BMW only sold 332,388 vehicles in the country in 2022, dropping them to second place. In 2022, Lexus sold a total of 258,704 vehicles, while Mercedes-Benz placed in third place with 208,764 sales. Looking ahead, Tesla not only surpasses these well-known brands, but also makes history by being the first American manufacturer to be ranked 1 in 25 years. Tesla is predicted to generate revenues of $20.69 billion in 2023, a significant increase in unit sales in the US. By 2027, the company is expected to have grown at a pace of 3.97% per year, with a predicted market volume of $19 billion. Morgan Stanley analysts see Tesla stock's current upward trend as a desirable entry option. The company had earlier changed its price target, which was $330 per share to $250. This change was designed to take into consideration the possibility that Tesla would find it difficult to meet future demand for EVs and a recent development. Despite the competitive nature of the EV market, Morgan Stanley analyst Adam Jones maintained an overweight recommendation for Tesla shares. Jones believes that Tesla has the capacity to thrive since it is backed by well-established, self-funded businesses with scale and efficiency. Tesla, like supply networks, stand a decent chance of succeeding in this market. Given that Tesla has grown by an astounding 4 times in just 4 years, it is possible that by 2027, the stock price of the business will have reached an astounding $1,000 a share. While it may seem impossible for Tesla to beat such industry giants, Morgan Stanley analysts boldly predicted back in 2022 that Tesla's revenue would approach $300 billion and surpass the total revenue of both Ford and General Motors within 5 years. By 2027, Morgan Stanley projects that Tesla's revenue will exceed the combined revenue of the two companies. Furthermore, Morgan Stanley predicts that by late 2026, Tesla will overtake GM in terms of its share of revenue from new car sales, and by 2030, it will surpass the combined market share of both Ford and GM with projected revenue of $300 billion. The analysts predict that marginal gross shares decline for Tesla competitors, which would be absorbed by Tesla itself. They suggest that Ford's market share could potentially decline from 12.5% to nearly 10% by 2030, while GM's unit shares might decrease from 14.6% to under 12%. In contrast, Tesla's wallet share could increase to 23% by the end of the decade. While downsizing and becoming less profitable can help Ford and GM stay relevant in the EV ecosystem, Morgan Stanley warns that these traditional automakers may face risks due to rising labor and material costs, as well as the execution of scaling future EV model launches. Despite Tesla's stock recent underperformance, looking ahead, the long-term outlook is still favorable. Based on its forecast compound annual rate for key financial measures, Tesla is expected to maintain its rapid growth over the next 5 years. Furthermore, following a spike in the company's stock price earlier this year, Tesla's valuations have become more reasonable. Despite investor concerns regarding the current market and Tesla's ability to maintain profitable vehicle sales in a challenging economic environment, the general consensus is that the company will continue to grow quickly. This is further supported by the company's expected compound annual growth rate for its top line revenue, net profit, and free cash flow. P, question, a prudent retirement option. Please share your opinions here along with your assessment of Tesla. If you'd like to see the most recent information about Tesla, click the next video that appears on your screen. We'll see you there.